Hi folks, Kevin Kramer, the IRA Center, Federal Employee Benefits Administration, for all of your retirement and income planning needs. Today, once again, we're going to talk about the 5-year amortized 10% real estate note. Say that 5 times without stopping. All joking aside, 5-year amortized 10% real estate note. Why real estate notes? Because they're safe. They can pay an excellent return if you know where to shop. Not all of them can be amortized, so you need to shop or just give me a call at 951-283-0443. Now, with that said, we're going to talk about a case of a client of mine that has $150,000 sitting in their individual retirement arrangement. That's IRS publication 590. So we just know it as an IRA. $150,000. It's not getting the returns that they want. They've had it for 4 years, and it's garnered them about $30,000. A little underneath that, about 26 to be exact. With that said, we're going to show them how they can not only have the $150,000, but make it into $313,000 in 5 years. So just a couple steps we have to get through to do that. Now, some of you are thinking in your mind, well, why don't they just take the 10% real estate note per year for the next 5 years? That would be $75,000 plus the $150,000. They'd be at $225,000 in 5 years. Now that's pretty good. My method, they're only going to have $187,000. Now, why in the world would you do that? Here's why. You cannot ladder with simple interest. It just doesn't work. So when you ladder using a amortized note, and that's the key, you get a return of principal and interest. Principal and interest. We know this is an IRA, so as far as the IRS is concerned, it's all interest. Understanding what they have, they realized that they're not going to meet their goals that they want to have in the next 5 years. They want the $300,000. Actually, they want more. They want $500,000. I said, not a problem. We're going to get you your $500,000. It will take 10 years for all of it to pour out, but we'll do it in 5 years. So here's how we do it. You take your note, you amortize it over 5 years. You'll receive an income stream of 3130.38, 3,130.38. Now, they're not going to take any income yet. As you can see right here, no withdrawals, but it will accumulate inside the IRA, so there's no taxation. Now, at the end of 5 years, it's poured out. They didn't do any laddering. They'd only have 187. Not very impressive, especially when you consider the note at 5 years by itself. Simple interest, $75,000. That sounds pretty good. Understanding what they have here now, they realized after watching the video a couple of times on a subsequent video that I shot, that if they amortize, they did the calculation, and they realized in 16 months, $50,000 was coming out of their hopper into their money pool. So they asked, why can't we just take that $50,000, because that's the minimum amount, by the way, you need to purchase one of these notes, and throw it in back of the hopper? And if we do that, won't it generate $1,043.46 per month for the next 60 months, starting from month 16? I said, yeah, that's exactly what will happen. And they said, so we'll get 60 monthly payments, and that comes out to a total of $62,607.60. I said, that's correct again. So in the 5-year window, they realize that they'll get 44 payments of $45,912. Now, they're still going to get the other 16 payments. It's just that it won't happen in the first 60 months. It'll happen in month 61, 62, 63, 64. In other words, until month 76, that's depleted. And then you'll add month 88 and so on and so forth. So we have 6 $50,000 accounts. As soon as they have enough money to open up another account, which will be month 28, now we'll have 3 accounts. The one with 3130, 1043, 1043. In month 38, 10 months later, another 50,000. In month 46, another 8 months, 50,000. In month 53, another 50,000, and then month 59. Now, if they decide not to do any more laddering ever again, here's what will happen. They'll have the $125,000 poured out, add the 187, that's where you get the 313. Now, we know that you have 6 of these accounts, 62,607, and that comes out to 375,645. The 375,645 times 6, 62,607, there's your number. So you could either divide it or you can multiply it, either one. 6 times that is that number. 6 divided into that is that number. So there we have the numbers. Now, $250,000 is owed to them, because remember, these months right here weren't all paid out. So they have to be paid out. So $250,000 will be paid out in years 6 through 10. So that brings us an actual overall balance of $563,000 if they do no additional laddering. But what most of my clients do is they'll ask me this question: Kevin, can we do this again? Well, sure. You can do it as often as you want. You just need $50,000. $50,000 at 10% gives you $1,043. Now, for some of you mathematicians out there, if you have a 15.85% return from $150,000, how would you do that calculation? Real simple. You get a basic calculator, and then you'll take 150,000, and then you'll just put the plus bar, 15.85, hit the percent key, do that 5 times, and you'll come up with a 313,038. So that's how we got 313,000 in 5 years, which was really 563 because of the laddering effect. So it works quite well if you use it properly. If you don't use it properly, it's not going to give you the results that you want. With that knowledge, contact me by way of email, the IRA Center at gmail.com. That address again is the IRA Center at gmail.com. As a federal contractor, I help thousands of federal employees or military employees who want to move their thrift savings plan into safety but get an excellent return at the same time. Federal Employee Benefits Administration email account is retirefed1@gmail.com. That again is retirefed1@gmail.com. And don't be afraid to text or voicemail to 951-283-0443. This is Kevin Kramer. Until the next time.